everyone. I hope you're really well. I'm Pamela Hastings, and welcome to another Barometer Webcast. We are thrilled to have you join us today while we continue to shelter in place and stay safe. It's the middle of June, and here we are. During this webcast, we will provide a review of current market and economic conditions. As always, I encourage questions from participants via the chat, or please email me at phastings@barometercapital.ca. We'll address your questions at the end of our webcast. And with that, I turn the conversation over to our Chief Investment Strategist, David Burrows. Hi, David.
Hi, Pam. Thanks so much. Thanks, everybody, for joining in today. I'm looking forward to kind of walking through some of the things that we've learned over the course of the week, as has been the case really since this whole crisis began. The investment team is spending a lot of time really trying to tease apart all of the various contributors to the way the market is behaving, the key drivers that appear to be influencing the decisions that investors are making, to help us make sure that we're targeting in the portfolios, productive assets, and that we have a good understanding of sort of what the current risk reward is. It's obviously a very conflicted market. We've had obviously very, very difficult economic conditions forced on us by COVID. And on the other side, there's all kinds of policies that have been put in place to try and support liquidity in the market and solvency from a business perspective. And all of those moving parts get put together, and in the end, price behavior comes out, and our job is to try and be in front of that and recognize the changes that are taking place. We've made the case now since the beginning that we remain in a secular bull market in stocks. This is the S&P coming out of the trading range it was in up to 2013. And there have been several pullbacks along the way, but the market's been able to hang on to long-term trend. And of course, we've had just a remarkable rally off the lows from the end of March. Market was down 38%, had a couple of waves higher, first a technical bounce, second, a move driven by fiscal stimulus. The market then churned sideways for a few weeks and then re-engaged as the COVID cases started coming down and as very early stage economic conditions started to change as we started to see reopening. And as we came into last week, we talked about the fact that we really were quite shocked that the market had been as strong as it has been and has moved as far as it has without any significant correction. We were sitting about 7% off the highs as of last week. We mentioned that all of the key long-term indicators that we had were positive, meaning breadth across major markets, our Canadian market, the US stock market, and the world. Breadth was expanding, and that's constructive, meaning more and more stocks participating in uptrends. And I also pointed out that our short-term indicators were all positive. However, we were getting to a point where they were really getting to be quite extreme. Percent of stocks above the 50-day moving average, we're sitting at like 98%. Percent of stocks with positive weekly price momentum, close to 100%. And we know that things don't go straight higher. So we said, the last couple of weeks, we think that there is some risk that we get a little bit of a pullback. Breadth, percent of stocks above the 50-day had got to 96%. And sure enough, that was about a day before we got this little pullback. Market pulled back actually close to 7% top to bottom over a very short period of time, 3 days. And it really highlights the conflict that we're seeing. I think that the sell-off was driven initially by Fed Chair Powell, making the case that while he was using extraordinary measures from a monetary policy perspective, they were doing it because they felt it was necessary, that the employment data, which of course has backed off so significantly, was likely to remain challenged for a couple of years, 2 to 3 years, and that 2 years from now, we may still have millions of people who had jobs going into COVID without jobs in their chosen field of work. And so it highlighted the fact that on one hand, you have this tremendous monetary stimulus where the Fed has said it's virtually unlimited what they're willing to do. And there's the old saying, don't fight the Fed. But on the other side, the realization that there are real economic consequences that have come out of this shutdown and that they all aren't going to heal right away. So the market has treated this as though we have a V-shaped recovery. It may well be looking beyond a larger V-shaped recovery in the economy, or it may be that we have more to go. But the net of it is very sharp drawdown, came right down into this moving average support, held, and despite lots of concern, had a very sharp rally back off it. We came into last week with breadth readings in the NYSE where 80% of stocks were in uptrends. That's very supportive. As you can see, it is a relatively high number when we go back over time, not too many times when more stocks have been in uptrends. And as a result of this little pullback, we got a move lower in breadth in the NYSE. So whereas a week ago, 80% of stocks were in uptrends, today 68% are in uptrends. Now, through the course of this rally, I've talked about the fact that when we do eventually get a pullback, it's going to give us a real sense for where the strength is in the market. Because in a healthy market, the leading stocks or groups start to rally first. In this case, it was technology and healthcare. And then along the way, other groups and industries may join the rally the further along you go. And one of the concerns is when some groups join a rally late stage, even if it's just a short-term rally, there is some question as to how they will behave when you finally get a pullback. Is the buying real, or is it short covering, people that were short things they thought would be hurt by the current environment and ultimately get squeezed in because the market gets strong enough? So we have had breadth turn down at the NYSE. We saw breadth turn down globally for equities. So that just gives us a little bit of pause. And while we do think that this is a short-term issue, and while our short-term indicators are still quite positive, this is something that we have to take seriously and really reevaluate all the holdings that we have. Now, this chart is just a really stark reminder that we've had very strong stock prices against very weak economic data, and in between is the conundrum. Which is it that reverses? Does the economic data and corporate profits reverse fast enough that they close this gap with price, or does price come down to match up with corporate profits? To this point, investors have been willing to say, I recognize that corporate earnings are challenged in the short run. We think that as we reopen, they're going to work their way higher. Last week on the call, we talked about some of the high frequency data that we've been looking at, and some of the data was the use of credit cards and debit cards and the fact that there are transactions taking place, and I think that that's really important. One thing that came up this week that gives us a little bit of pause is that yes, they're being used, but this is the percentage of cards that are 30 days delinquent. We have certainly seen a rise in delinquencies over the course of the last couple of weeks. So if people are using their cards, they may not be paying them quite so quickly. We know there's anecdotal evidence in some areas of real estate that people are not paying their rents. And certainly while people have had forbearance on some of their costs, they're ultimately going to have to pay them. So it's really important that the Fed creates liquidity. And of course, as soon as we saw weakness in the market, we had more talk of stimulus. The Fed came in and said they would start to purchase individual corporate bond issues to support the corporate bond market, which ultimately gives corporations a license to go out and raise money in the bond market to make sure their balance sheets are okay. That was seen as quite positive. Also, the Trump administration started talking about an additional round of fiscal stimulus, as much as $1 trillion, which is yet to be defined, and has actually come up 2 or 3 times, but seems to come up at opportune moments when the market gets a little bit sloppy. But that seemed to have calmed the market down enough to rally it back toward where we were a week ago. I think that the most important chart that we can see is this chart, which plots in red global liquidity in asset markets. That's monetary stimulus. And yellow, what global asset prices are doing. And what it highlights is, going back to 1981, there's a very high correlation. When there's lots of liquidity, asset prices go up. And this spike in liquidity that we've had since the COVID virus began really can only be matched by the liquidity that was pushed into the system back around the Plaza Accord in the early 1980s, which of course fueled the bull market of the 80s. So we don't want to fight the Fed. We don't want to also, though, whistle by the graveyard and ignore the fact that there are economic challenges that we're going to have to work our way through. But markets aren't going to wait for the all clear sign. They will rally against difficult conditions if they sense that things are getting better. So things that we have in our favor. We highlighted last week that there are lots of people who are concerned about economic conditions. And so lots of people have borrowed S&P 500 units to be short. So there's a large short position against the S&P. There's also a large short position in S&P 500 futures. Those ultimately need to be bought back. So on weakness, there is a natural buyer to come in and buy weakness. And we certainly saw that when the market pulled back. So some things that we learned over the course of the past week. First of all, most importantly, the leadership that we have perceived in the market, which was leadership going into the decline, has been leadership coming out of the decline. This is rising relative price strength versus the market, continues. So this is a chart of the technology sector in the US stock market, making today new relative strength highs, trading virtually at absolute highs, despite the fact actually today was a bit of a sloppy day. So within technology, we continue to see strength. And even with that little wobble last week, right back to highs for cloud-based computing, semiconductor companies, software companies, especially including cybersecurity, autonomous driving and robotics, relative strength new highs, absolute highs. Healthcare relatively underperformed over the last 2 weeks. And not to say that that's a big problem, but again, we take our cue from the market. When we start to see relative price strength wane, we reduce our weights. We reduced our weighting somewhat in healthcare this week. What else did we learn? Mobile payments continue to be very strong for obvious reasons. Golds continue to be very constructive. They pulled back a little bit, but firmed up over the last 4 days. Very constructive consolidation over the last week or two. Consumer discretionary in general continues to be very strong. This is the VCR ETF, which is a broad basket of consumer discretionary companies making new relative strength highs. First of all, probably driven by internet retail and our friends at Amazon and Shopify. So leadership we learned this week, despite a wobble, tested well and rebounded quickly. That's what we want it to do. Leadership stocks and leadership sectors should be like a little cork that get pulled down underneath the surface. When you let it go, it just pops right back up again. So this continues to be strength. These are all themes that are not hurt by the COVID crisis. In fact, they probably are accelerated in many cases. So what else did we learn? We talked over the last 2 weeks about how banks finally had a good lift, but that we were coming into some resistance. And when we did get a pullback, it was a pretty sharp pullback in the banks. Certainly more than the market. And on the bounce, as the markets bounced over the last couple of days, they haven't bounced quite as much as the market. So while things are improving, they still have some work to do. And clearly there's still some concern around potential write-offs in the loan books. Industrials the same way, had a great 2 weeks leading into that little pullback, pulled back more than the market, have rallied a little bit less than the market on the bounce. So what I would say is that from the messaging that we got from the Fed and what we're getting from other folks who are in the thick of things, the economically sensitive companies still have some work to do. There's still risk around these companies and how quickly the earnings will come back. I mentioned healthcare that we reduced somewhat. So our weightings continue to be strongest around technology, strongest around consumer discretionary. We added certainly some banks and industrials over the last few weeks. We reduced our healthcare a little bit, and we just continue to take the cues. Now, I'm not so concerned about the pullback in financials and industrials because the flows out of financials and industrials over the last year and the last 3 months have been significant. So they are the most underweight sectors in the market. So there are not large positions that have to be unwound. In fact, they're probably underowned, and there are people prepared to buy the dip. Other things that I think about. This is positioning in the bond market. And we know that portfolio managers have bigger, far bigger positioning in bonds than they have had in over 20 years. So we always get concerned about the crowded trades and where the risks lie. I know that people are in the bond market because they think this is a safe place to be. But having said that, since February, bond prices in the long end, 10-year and 30-year bonds, have been falling. So they're not only getting a very small coupon, but bond prices are falling. And that has an impact on anything that acts like a bond. So the next most crowded trade has been utilities. And you can see that utilities have been relatively underperforming since March as people have taken money from this group to move into others. As you know, we had a utilities weight coming into the decline. We definitely reduced it going through the decline, and on the bounce, we've continued to reduce our weights. So we really are in a market of have and have-nots. The leadership groups are showing remarkable resilience. The earnings and the revenue numbers are coming in ahead of expectation for most of these big structural themes. And while the market has patience looking forward in some of the more economically sensitive groups, there is less conviction. So as we come through the end of this week, we continue to be a little bit cautious. We are in June. June can be a sloppy month. There's a big option expiry this weekend. We could see a little bit of bumpiness around that. Our indicators are giving us some mixed signals, so we recognize that. Some of our portfolios are a little more aggressive, like equity. Some of them are set up to be more defensive to try and take advantage of pullback, like global macro. And of course, the income portfolio is meant to be very muted. So the net of it is, we think that ultimately bonds are quite crowded, $66 billion so far into bond ETFs, and they've been falling really since March. Equity is relatively underowned, positioning quite defensive, and behaving in general quite constructively. We think that there is a lot of money that can ultimately come back into the stock market. There's over $5 trillion sitting in money market funds. And we think that as money starts coming out of bonds, as the economy recovers, that's going to be supportive of equity prices as we go forward. So the long run picture continues to be quite positive for US stocks. International stocks, not quite as positive. And specific sectors and themes really, we think, have clear leadership, so being targeted much better than being broadly based in every sector. If things get more difficult, certainly we can get defensive, but the very light weighting in equities overall by portfolio managers doesn't bode for a major unwind in equities. So we've had a nice recovery. We've had a little shot down as a test. We'll see whether that is over. Ultimately, we look forward to reclaiming the old highs. We're not saying that's going to happen immediately, but we are saying that when we get these little shots, like we did in April and we did last week, it helps us to gut check and say, is our portfolio constructed and aimed in the right spot? And right now I can say with pretty good confidence that we are focused in the strongest groups in the market and the portfolios are in good shape. If things get difficult, we'll certainly get more defensive. We're happy to do that, but we'll take this step by step. So Pam, if there's any questions, I'm certainly happy to answer.
Hi, Dave. Thanks so much. We don't really have any questions today. I guess everyone in Ontario is out enjoying the beautiful weather that's upon us, and I don't blame them. I would like to wish all of our clients and prospective clients that are fathers, happy Father's Day from Barometer. And Dave, if you have any other insights to share?
No, if there's anything big, we can certainly share it between meetings, but we'll look forward to another update next week. And I want to thank everybody for taking the time to tune in today. Have a great week.
Thanks, everyone.